The average American mortgage payment in 2025 was $2,329 per month. That is principal and interest, nothing else. Add property taxes, insurance, and a basic maintenance reserve, and you are looking at roughly $3,000 gone before you have bought a single grocery. The median American household takes home around $5,400 per month after federal taxes, state taxes, and FICA, which means the median mortgaged American is spending more than 50% of their take-home pay on the house before the rest of life begins. Financial advisors call anything above 28% a red flag. We are running at nearly double that, and we have quietly agreed this is what responsible adulthood looks like. But here is what I actually want to tell you, and it is the part the bank will absolutely not explain when you are signing the 30-year paperwork. Paying off your mortgage does not make you richer, not immediately. What it does is structurally different and in some ways more powerful than the net worth calculation. It changes the cognitive overhead of every financial decision you will make for the rest of your life. It changes which jobs you will accept, which risks you can absorb, whether you can afford to be wrong, whether you can afford to leave. Most people spend 30 years focused on the monthly payment. The more important thing happening in parallel, quietly, invisibly, every single month is what the mortgage is doing to how your brain makes choices. That is the story. And by the end of this video, the math is going to feel almost secondary. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard methodology to expose the specific weak points in your plan. And I only ask for your email to send the report because I don't store any of your financial data. Link is in the description. Now, I want to introduce you to something I call the silent partner. Every business story you have ever read where a founder finally bought out a passive investor and immediately started doing things differently, taking bigger swings, making faster decisions, pivoting when the company needed it, that is not a coincidence, and it is not purely emotional. The silent partner was not doing anything wrong. He was a legitimate stakeholder, but he had a seat at every meeting. He had a prior claim on every dollar of revenue. And as long as he was there, every major decision went through an unspoken filter. Will this threaten the partner's cut? Your mortgage is the silent partner. For the length of your loan, it has been a passenger in every financial conversation you have had. Every job negotiation happens with the partner in the room. Every career conversation gets filtered through one question. Does this threaten the payment? You want to start something on the side? Better not let the primary income dip while the partner still needs paying. You want to take a lower salary for work that matters to you? The partner doesn't care what matters to you. The partner wants the same $2,800 it wanted last month, and the month before that, and the month before that. The silent partner never shows up to work, never solves a single problem, never expresses any interest in what you are building. It takes 30 to 40% of your disposable income every single month for 30 years and holds a quiet veto over your life in return. When the mortgage is paid off, the partner is bought out. You own 100% of the operation, and the decisions available to you the next morning are fundamentally different from the ones that were available the day before. In a few minutes, I am going to show you what the research actually says about what debt elimination does to your cognitive function. And the numbers are more specific than anything you have seen in the self-help version of this conversation. But first, let me deal with the math argument that someone is already drafting in the comments, because it is not wrong and it deserves a serious answer. The invest the difference argument goes like this. If your mortgage rate is below 5%, you are mathematically better off investing the extra cash than prepaying principal. Wharton professor Michael Roberts ran a rigorous version of this. On a $500,000 mortgage at 3%, investing excess payments in equities outperformed early payoff in roughly 95% of historical 30-year windows. The logic is airtight. A guaranteed 3% return from eliminating cheap debt loses to a historical 8% return from equities. About 82% of existing American mortgage holders have rates below 5% right now. So if that's you, the spreadsheet says invest the difference. Here is what the spreadsheet cannot know. It assumes you actually invest the difference. Research on consumer behavior consistently shows that discretionary cash money that is not pre-committed to a specific payment gets absorbed into lifestyle at a significantly higher rate than people predict for themselves when asked in advance. The mortgage payment was forced savings. Remove it and replace it with an optional monthly decision to invest, and a meaningful percentage of households absorb that freed capital into lifestyle creep within 18 months with nothing to show for it. Not because they're irresponsible, because discretionary money is genuinely easy to spend and genuinely easy to justify in the moment. The spreadsheet also assumes you have the psychological durability to watch your portfolio drop 40% in a market correction, while still owing $2,500 per month in mandatory housing payments. Because the math says stay invested. History says stay invested. But the human being watching $120,000 evaporate from their brokerage account while writing the monthly mortgage check is not in a spreadsheet environment. They are in a panic environment. And panic environments produce the single most destructive move in the history of personal finance, selling low, which permanently destroys the compounding that made the invest the difference strategy correct in the first place. You think the monthly payment is the problem. The actual problem is the decision-making environment the monthly payment creates. At mortgage rates above 7%, which covers most people who bought since 2022, aggressive principal paydown is a guaranteed return that competes favorably with almost anything in the market on a risk-adjusted basis. Between 4.5% and 7%, it is a genuine judgment call that depends on your actual behavior, not your theoretical behavior. Below 4.5%, invest the difference, but build a mechanical system for it. Automatic transfers on payday, not an intention. Intentions are the most expensive financial product in existence. The real answer, as usual, is not a number. It is knowing yourself. And here is the uncomfortable layer on top of that. You have been making every version of this decision, including this one right now, from inside a state of financial constraint that measurably impairs your reasoning. More on that in a minute. Two things I find genuinely funny about the total cost of a 30-year mortgage, if you can tolerate a dark enough sense of humor. On a $450,000 loan at 6.5%, you pay $573,840 in interest over the life of the loan. Not principal, interest. More than the entire original value of the house. The bank will collect more from you in interest alone than the building was worth the day you signed. It is genuinely impressive as a business model. You would think they would send a card at year 15. Something small. A gesture. The total payment schedule over 30 years on that same loan is $1,023,840 for a $450,000 house. Both parties signed that contract and called it a good deal. I find this less enraging and more educational. The bank ran the math before you got to the table. Make sure you run it too. Now, the psychology research. This is the part I keep returning to. A 2019 study published in the Proceedings of the National Academy of Sciences tracked participants before and after complete debt elimination, not reduction, elimination. Anxiety fell from 78% of participants showing clinical symptoms to 53%. That is a 25 percentage point reduction in diagnosable anxiety from closing debt accounts. Not from having more money. Participants also scored measurably better on cognitive assessments after elimination. Partial paydown produced some benefit. Complete elimination produced a qualitatively different result, which tells you something important about how your brain processes outstanding obligations. The finding that stopped me, the number of accounts closed, mattered more than the dollar amount of relief. Eliminating a $3,000 credit card produced more measurable psychological benefit than a $5,000 partial reduction on a larger debt. The brain does not calculate relief in dollars. It calculates it in open accounts, in background processes still running. Think about your computer with 40 tabs open. The processing speed is not degraded because any single tab is doing something demanding. It is degraded because every tab requires continuous background resource allocation. Your mortgage has been running in the background of every financial calculation you have made for years. Every career evaluation, every risk assessment, every time you thought about doing something different. the background process runs. The silent partner weighs in. And eventually, you stop noticing it the same way you stop hearing the refrigerator hum until it stops. Northwestern University researchers separately confirmed that carrying high debt-to-asset ratios correlates with measurably higher blood pressure, elevated rates of clinical depression, and worse self-reported health outcomes, even after controlling for income levels. This is not metaphor. The mortgage is a physiological obligation. Your cardiovascular system has been carrying it alongside your balance sheet. When it closes, your body notices. Harvard economist Sendil Mullainathan and Princeton psychologist Eldar Shafir spent years studying the cognitive impact of financial constraint and produced what I think is the most important number in personal finance that almost no one has heard. Financial stress, the persistent feeling of scarcity, of having less than you need, functions as a cognitive tax. Their estimate: the psychological burden of financial constraint costs people the equivalent of 13 to 14 IQ points in real-time decision-making capacity. 13 points. That is the difference between performing at your actual level and performing meaningfully below it every day on every problem requiring sustained attention. You have been making every major financial decision of your adult life, including the one about whether to pay down the mortgage or invest the difference, from inside this constraint. You have been running the calculations with a slightly slower processor than the one available to you without it. This is not an indictment of your judgment. It is an indictment of the conditions. And the conditions change the day the silent partner is bought out. By the way, if this kind of analysis, the mechanics of how money actually moves through people's lives rather than how financial products want you to think it moves, if that's useful to you, hit subscribe. The YouTube algorithm is genuinely indifferent about whether it ever shows you my videos again. I cannot fix that from my end. You can. Now, let me show you exactly why this matters in terms the financial independence community understands. The 4% rule says you need 25 times your annual expenses invested before you can stop working. It is not a perfect formula, but it is the functional standard. What most people applying it do not fully absorb is that the number is not fixed. It shrinks when your expenses shrink. And eliminating the mortgage is the single largest expense reduction most American households will ever experience. Meet Daniel. He is 44 years old, married with 2 kids, living in Charlotte, North Carolina, combined household income of $115,000 per year. He bought his house in 2015 for $380,000. Current mortgage balance is $220,000 at 4%, monthly payment of $1,812. After taxes and a modest 401k contribution, the household takes home around $6,800 per month. Daniel and his wife have $260,000 across their retirement accounts. They have been running the financial independence math since 2021. The number they keep landing on is approximately $1.7 million based on current annual expenses of $68,000. At their current savings rate, a financial planner told them they would reach that at 61. Daniel would rather get there at 55. Here's the calculation Daniel has not run. If he and his wife redirect their discretionary cash toward principal paydown and eliminate the mortgage in the next 6 years, achievable without heroics, but not without intention, their annual household expenses fall to $44,000. Their financial independence number drops from 1.7 million to 1.1 million. They did not earn a single additional dollar. They did not get promoted. They did not launch a business. They changed what survival costs. The gap they need to close fell by $600,000. Daniel gets to 55, not because he executed a complex strategy, because he recalculated the finish line. Now, there is a subplot I've been building toward that I want to track through the rest of this, because it illustrates something the numbers alone cannot capture. There is a man named Ray. He spent 23 years in corporate IT project management in Columbus, Ohio, which is exactly as thrilling as it sounds. He was good at it. It paid well. In 2004, he bought a house for $310,000, 30-year mortgage at 5.7 to 5% a monthly payment of $1,808. He threw extra money at principal whenever he had a good month. Not systematically, not on a rigid schedule. When it felt possible, he did it. He paid the loan off in year 21. 2025. He was 53 years old. Hold that number 53 mortgage-free while we look at what acceleration actually costs you on a monthly basis, because I think most people dramatically overestimate the sacrifice involved. On a $450,000 mortgage at 6.5%, switching from monthly to bi-weekly payments costs you nothing in real lifestyle. You cut the monthly amount in half and pay every 2 weeks instead of once a month. This creates 26 half payments per year instead of 24. The equivalent of one full extra payment annually. The result is 5 to 6 years off the loan and $119,000 in interest eliminated. One changed habit. $119,000 gone from the bank's column and kept in yours. Add an extra $500 per month to principal. On top of that, 8 years off the timeline, $150,000 in interest eliminated. An extra $1,000 per month shortens the loan to roughly 17 years. None of these are dramatic sacrifices. They are the difference between buying out the silent partner at 55 versus 63, and the life available to you in those 8 years. The decisions, the risks, the options is not a small difference. It is 8 years of Ray's life. Back to Ray at 53, mortgage gone. When he made that last payment, he described it as disorienting, not painfully. He said it was like having a very quiet sound in the background of an apartment for so long that you stopped registering it as noise. And then one day, silence. Complete, unfamiliar silence. The hum he had not consciously heard for 21 years simply stopped. For the first couple of months, he kept looking at his bank account confused. $2,000 a month that nobody had a prior claim on, not allocated, not claimed. No silent partner waiting for its cut. What Ray did next is worth paying close attention to, because Ray is not a finance guy. He is a project manager. He did not immediately max out every account or build a color-coded spreadsheet. He did two things. He started declining projects at work that did not interest him, politely, without drama. His manager, who had never heard this from Ray in 23 years, had a tense conversation with him about it. Ray did not backpedal. He used to backpedal. The math used to require it. The new math did not. The second thing Ray did was start a consulting practice on the side, helping mid-sized companies implement the same IT frameworks he had been building for corporations. He had thought about this since 2021. He had not done it because the startup phase of any consulting practice involves irregular income, and irregular income with a mandatory $2,000 monthly housing payment is a categorically different risk profile than irregular income with no mandatory housing payment. One scenario is uncomfortable. The other scenario is the one that causes people to quit too early and confirm the belief that working for yourself doesn't work. By the end of 2025, the consulting practice was generating $22,000 annually and growing. His corporate salary was still there. He was not rich, but for the first time in his working life, he was negotiating his employment from genuine optionality. The job was contributing to wealth building. It was not the wall standing between his family and financial collapse. And jobs that are optional are, in my observation of how people actually perform in them, the only ones where most people work at their real level. The silent partner was gone. Ray owned the operation entirely. The decisions available to him at 53 looked nothing like the ones available to him at 52. This is where the numbers should make you genuinely uncomfortable. About 40% of American owner-occupied homes are currently mortgage-free. Sounds positive. Then you look at who those people are. 63% of homeowners 65 and older are mortgage-free. Fewer than 28% of working-age homeowners are. The average age of full payoff sits between 58 and 63. The median first-time homebuyer age just reached 36, up from 29 in the 90s. A 30-year mortgage signed at 36 does not close until 66, 3 years into what used to be called retirement. In 1989, 3% of homeowners over 80 still carried a mortgage. Today, nearly 30% do. The share of 65 to 79-year-olds carrying mortgage debt has risen from 24% to 41% over 30 years. Median mortgage debt among seniors is up 400%. We are dragging housing debt into old age at a scale that has no historical precedent in this country. And we have normalized it, treated it as the expected shape of a financially responsible life, which it is absolutely not. Only 23% of all Americans are completely debt-free. No mortgage, no car payment, nothing. What we are discussing today is genuinely rare. And the people who cross this finish line consistently report something they could not have anticipated before getting there. It is not primarily relief about the dollar amount. It is a silence they did not know was missing. 23% debt-free. 77% still riding with a passenger. I keep hoping that number will get less funny. It has not. One more thing I need to be honest about, because I said earlier I would give you the real numbers and not the fantasy version. The house is not free when the mortgage is paid off. Property taxes have increased 27% nationally since 2019. In New Jersey, the median property tax bill is $743 per month. Mortgage or no mortgage. You are paying rent to the state indefinitely. And no amount of principal paydown changes that. Homeowners insurance has jumped 52% since 2020 because the atmosphere is conducting its own financial experiment and the premiums are how it sends the invoice. And the 1% annual maintenance rule, budget 1% of your home's value per year for repairs, still applies. On a $400,000 home, that is $333 per month reserved for the water heater that will choose 11:15 on a Sunday night in December to announce its retirement. Add it up, a paid-off home still costs roughly $838 per month nationally, closer to $1,200 or $1,300 in high-tax states. So when the $2,800 payment disappears, you do not get $2,800 to deploy. You get roughly $2,000 in new, genuinely free capital, which is still compounded at 8% over 20 years, $1,177,000. But plan for the real number. The gap between what you expected and what you actually have is exactly the size of a November property tax bill that will ruin a perfectly good Tuesday if you were not expecting it. Now, what you actually do with the freed payment, because this is where most people fumble after doing everything right for 2 decades. They arrive at the finish line with no concrete plan, and the freed cash quietly dissolves into an incrementally nicer version of the same life over the following 24 months. The silent partner leaves and comes back wearing different clothes, a slightly upgraded car, a renovation that made sense at the time, a subscription layer that compounds in the wrong direction. 3 levels. Do them in order. Level 1 is protection. Verify your lender filed the lien release and that the deed is in your name. Mortgage servicers occasionally do not do this automatically, and you find out when you try to sell, which is a very specific kind of administrative surprise that I file under both tedious and essential. Then, rebuild your emergency fund to 6 to 12 months of your new, lower expenses. You've been financially tight for years. Liquid savings come before ambition. Level 2 is acceleration. Take the former mortgage payment and cascade it through tax-advantaged accounts in order 401k employer match first, because a 50 to 100% guaranteed return exists nowhere else in finance, and nothing on this list comes close to it. Max the Roth IRA. $7,000 per year in 2025, grows completely tax-free. The IRS never touches the gains. Max the 401k contribution limit, $23,500 in 2025. Fund a health savings account if you are eligible, the most tax-efficient savings vehicle in the federal code. Then pour everything remaining into a taxable brokerage account, holding low-cost index funds. $2,000 per month through this cascade at 8%. In 5 years, $146,000. In 10 years, $365,000. In 20 years, $1,177,000. You contributed $480,000 of your own money. The market contributed $697,000 on top of that. The majority of your eventual wealth came from compound interest. Not from discipline, not from sacrifice, not from anything clever. From giving compound interest enough room and enough time to do what it always does when a mandatory housing obligation stops standing in the way. Level 3 is the one nobody covers in finance content because it is hard to quantify and impossible to monetize. It is permission. the permission to take the career risk, start the business. Say no to a client, a boss, a situation that is quietly costing you more than money. Most people never reach level 3 because they build a lifestyle at level 2 that requires level 1 all over again. The partner leaves and is replaced by a different partner, different name, same veto. Avoiding this protecting the floor you worked for is, in my view, the most underrated financial discipline available. Not because it requires exceptional character, because it requires a clear picture of what you are actually protecting and why. Now, the part that closes the entire frame. Academic research published in 2020 found that improved housing security, meaning lower or eliminated mortgage obligations, produced statistically significant increases in new business formation, particularly among women and non-white entrepreneurs who are disproportionately affected by financial exposure. A separate study found that leveraged homeownership, meaning carrying an active mortgage, significantly reduces entrepreneurship, with the effect strongest when loan-to-value ratios are at their peak. The mechanism is exactly what you would expect. Every dollar committed to a mandatory monthly payment is a dollar that cannot absorb risk anywhere else. Every mandatory payment is a reason not to try something that might take 18 months to become profitable. The silent partner was not taking money. It was taking options. The mortgage was always a 30-year employment contract that most people signed without recognizing it as one. As long as the partner needs paying, neither you nor your spouse can afford to leave a job you genuinely dislike. Take a pay cut for work that matters more. Absorb a business risk that needs a real runway to play out, or make any decision that might interrupt the income that feeds the payment. You are financially obligated not because you are weak, but because the math requires it. The contract requires it. And the contract runs for 30 years unless you deliberately shorten it. Ray at 53 took an early separation package the same day it was offered. Not recklessly, the math worked without the mortgage in the equation. He had the emergency fund, the retirement contributions, the side income, the freed payment automating into index funds. He had a floor low enough to make the jump survivable. He told me later that if the mortgage had still been there, he would have asked for time to think about it and spent that time running the same numbers he had been running for 20 years. Instead, he ran the new math, the mortgage-free math. The answer came back in about 4 minutes. That is the return that does not have an APR. That is the return no advisor sells because it does not generate a fee and it does not create demand for a product. Nobody is standing at the bottom of this on-ramp with a brochure, but it is, in my view, the most valuable inflection point available to most American households, hiding inside an obligation that nearly everyone carries and almost no one is deliberately accelerating. So here is what I want you to actually do. 1. Calculate your financial independence number, both with and without the mortgage. Not the generic retirement estimate. Your specific number, based on your real expenses in both states. The difference is almost certainly larger than you have run, and in many cases changes the entire timeline you are working toward. Run Daniel's math for your household. It takes 20 minutes, and the result is worth more than most financial consultations. 2, know which rate regime you are in and be honest about your actual behavior, not your theoretical behavior. Above 7%, aggressive paydown is a guaranteed return that nothing in the current market matches on a risk-adjusted basis. Between 4.5 and 7, run the real calculation, which includes your honest probability of investing versus spending the freed cash. Below 4.5, invest the difference, but automate it the same day so it never touches your checking account with an open question about where it goes. 3, on the day the last payment processes, treat the freed amount exactly like a direct deposit paycheck. Automate it to its destination before the first month of freedom ends. Freed cash that sits in checking finds a purpose that is rarely compound interest. The window between closing the mortgage and establishing the new automated habit is where most people accidentally lose the most valuable financial moment of their adult lives. Do not be sentimental about it. Schedule the transfer. Then do something else with your Sunday night. The silent partner has been in the room for most of your adult financial life. Quietly collecting, quietly voting. The path to buying it out is not glamorous. It involves extra payments during years when you would rather do something else with the money. It involves not letting the freed cash turn into a nicer version of the same life. It involves protecting the floor when everything in consumer culture is designed to raise it. But the people who get there, Ray at 53, Daniel's plan at 55, whoever it is for you, they report the same thing consistently without exception. Not that they feel wealthy, not that the number is finally large enough. They report that they can make decisions based on what they actually want rather than what the partner requires. The grip releases, the tab closes. The background process stops running. Lazy investing built more fortune than crypto memes. The mortgage was always the slow, boring, quiet version of the game. The people who understood that earliest are the ones who stopped running the Sunday night math problem first. Everyone else is still in the dark doing arithmetic.